Should probably get cranking, huh?
Ready to go?
I'm ready. Ready when you're
All
ready.
right, let's just do a quick sound check. Everybody here, what's up? What's up? What's going on? Can you hear us and see us and also see the screen? Okay, everything good? Loud and clear. All right.
All right.
All right,
Chris
sounds
Beckman,
good.
what's up, man? Chris, you owe me a trader interview, man. Come on, give me some interview footage here. Or
Oh, C-Kip?
yeah,
C-Kip?
yep. Got called out. That's
Yeah.
all right.
He says he's busy. You know he ain't busy.
All right. Is Eric ready? Is he?
Let's ping Eric here.
Is it bright enough? Yeah, it is bright enough. This is great.
Yeah.
You gotta move that out.
All right, Eric is ready, so I leave it to you, brother.
Let's do it. All right, guys. Well, welcome to the first of what is going to be a 4-webinar series that Anand, also known as Sang Lucci, and I are putting on for your benefit for free, because that's the kind of thing that we're doing these days. And what this presentation is going to be all about is how does Lucci's trading style, right? His method of trading options, how does that differ? How is it so different from the way a lot of professional options traders approach options? Okay, if you're completely new to the game, you're coming in, you might just look and say all options traders, are the same, and they probably use one options pricing methodology, and it's just about what you do with that counts, and that is not the case at all. So what this is really going to be about is us diving in and looking at how Lucci's approach to trading options, which is trading options kind of like their stocks, is such a differentiating factor for him. The advantages that has given him, some of the drawbacks, right? Why the other reasons why people, will trade options differently. And I'm sorry, I'm getting an alert that we're full, which is cool. We're at capacity, which good. Everyone else will have to get the recording, guys. So, we're going to run through a lot of very, very good content here for you guys. And like I said, this is the first of 4 that are coming up. So if you guys have questions, you guys are here live. So you're actually the ones who can have the luxury to ask questions. Otherwise, everyone else is going to have to catch us on the recording. So, Luch, without any further ado, let's hop into this, man. I mean, I'm sure everyone is itching to hear about this. So,
cool.
Give everybody a quick rundown of just, like, let's say they're completely new to you, to Sang Lucci. How do you, when you're looking to get into an options trade, what is the first thing that you're looking at, right? What is the catalyst that's going to get you to jump into that trade?
Yeah, the catalyst is always that the time and sales, the tape, so to speak, the proverbial tape on the equity. So essentially, all it is this right here. So looking at a level 2 of your, of the stock that you're taking a look at, and the time and sales, and the transactions. So that is literally it. That is the catalyst. I'm looking for buyers and sellers. And I'm looking for sort of supply and demand. So that's been my mode of transportation for the last 7 years, basically, since I started.
Right. And so right off the bat, that's what we're talking about, and you said it yourself, is you're looking at the equity. You're looking at the underlying, right?
Yes.
Let's start and talk about what was the deciding factor for you when you started trading the equities that you did trade, when you only traded equities back in the prop firm days. We call them the high flyers, stuff like Apple, Google, Amazon, Priceline, Bank of America. Some of the financials are in there.
Right.
What's the criteria that you were really looking at?
Yeah, honestly, this is a pretty funny story. I mean, when you work at a proprietary trading firm, and by the way, for anybody who's here and doesn't understand what a proprietary trading firm is, it's basically a shop where you can bring a little bit of capital, $2,000 to $5,000. You can get leverage on your money. You can get professional tools. You can get education, and you literally become a trader. That's your job. Your job is to be a trader. And, they're also going to put restrictions on you, though. They're going to put restrictions on you as far as how many shares you can trade, what kind of stocks that you can trade. So what they want you to do, and when I say they, I mean the general sort of prop trading world, is they want you to trade, stocks that are fairly priced, meaning, anywhere from $20, it could be anywhere from $5 to, let's say, a maximum of $50 to $60. Your J.P. Morgans of the world, your Wells Fargos, your Las Vegas Sands, your, that kind of price range, your Potash, your United States Steel, and names that are around $30 that move decently, but they're not crazy. They're not labeled as these crazy movers. And why is that? Well, they want to make sure they do their risk management on you, because remember, if they're going to give you leverage of, let's say, 10 times your money, or let's say 100 times your money, they want to make sure that they're also keeping tabs on you and making sure that you're not doing anything kind of wild and crazy here. And what that means is names like
so well.
Right, exactly. And I would look at this and I'd be like, well, man, these smaller names, they don't move enough for me. They don't, I can't, to go for 10 cents or 20 cents on a stock every single day, 100 times a day. It was a little bit too, I was like, I don't really see the point of this, and realized that prop trading firms, they want you to trade. Like, they need you to trade a lot. They need you to churn commissions. And as long as you're trading a significant amount of shares, and they can make a lot of money off of you, and they do. So I started
that's their models built on the commissions generated by their traders. There's other firms that take in their traders. It's different approach, right? But yeah, that's the type you were at.
Right, exactly. So what ended up happening was, I started moving towards, names like Apple, names like, at the time it was CME. This was a big one. This was like a $500 stock. And my firm or my head traders would be like, oh my God, what is he doing? Because I'd have a 100-share position in something that moved 10 to 20 points, and I'd be up or down like 800 or $700 just on this one trade. And they were like, oh my God, we can't handle this kind of risk. And eventually it got to the point where there was a lot of screaming and shouting matches, on my ability to trade these things. And they didn't want me trading these things. And if you tell me not to do something, I mean, what's going to happen.
Yeah. Okay, so they were pushing back on you, and essentially the reason that you were getting into it was because you wanted volatility, right? You wanted moves. You need significant percentage basis swings in order to see a return on your money, the kind of return you were looking for, right?
Yes, absolutely. And that's when I started gravitating more towards names that were a lot more volatile, higher price names, $100 stocks, $200 stocks, sometimes even $500 stocks. Those were the ones that I wanted to trade because they were just going nuts. And at the time, it was all the agriculture stocks. So it was like CF. CF was 100 and change maybe. Potash was like $150. She split here, so that's why it's only worth 35. Mosaic was up there. Monsanto was up there, and these were names that I wanted to trade all the time. And pretty soon the firm was just like, all right, we can't let you do this, and blah blah blah, all this kind of stuff. So we just went back and forth all the time. Like, listen, this is the way I want to trade. I have cash in my account. You can't tell me I can't trade this stuff. So it'd just be back and forth here, that kind of thing.
Gotcha. And so then you went from there, and then you start trading options, right? I mean, the way you put it to me when we were talking today is because, and we were kind of preparing for this, was you said, I went to options because that was the place I saw the opportunity to make life-changing money, right? Like, you weren't in this to like make side income. This was a full-time job. You wanted to make, money that would actually change your life, right? You had a daughter to support, your girl was in the equation. So talk a little bit about like the first, like, just kind of the math of that, right? How does that work? Like for someone who's just new to options here, why is it that you can make so much more in options compared to one of these equities that's moving,
Right. So it's not like you can make so much more. What it should be phrased as is that for the amount of money that you have,
Right. Right.
you can make so much more. You know?
Right.
Because I'll give you plenty of examples, and this is where I really want to tell you guys, how I got to the point where, I wanted to trade these options. First, let me tell them the story about the flux capacitor, man. Let me do that story here.
Oh, man,
Because this is a necessary story. He has a page here in my life. Everybody here knows the flux capacitor. I mean, you guys have seen Back to the Future, obviously. We called this kid in our office. We called him the flux capacitor because he knew everything about everything, right? So anytime I needed some information about a stock or a company or whatever, I'd be like, "Yo, Flux, let me get the news on LVS earnings and blah blah blah." And in a second, he'd give me back the information that I needed, right? And he was a horrible trader, okay? And simply because he was such a smart kid, right? And he needed to be right about everything. He was miserable. He couldn't make a dime. But he kept telling me about options. And I'm like, yeah, whatever. And then finally, I had enough. I had a bunch of money sitting in a side account. I was like, all right, screw it. Let me just throw out a trade here. And the trade was in like Cheesecake Factory off of an earnings call or something. So I put $1,000 down on a call option, and the next day the stock ripped maybe like 3 or 4 points, and I made like $2,000 on that position. And then I'm like, I've never doubled my money in my life. Like, that's never happened here, especially in the equity world. That never happens. It literally never happens.
Right.
And I'm like, oh my God, how do I put? And immediately I'm like, how do I put $250,000 in this, and then make that kind of money, right? So that's immediately how I was thinking, and that's immediately what tied me towards it. Now, as far as the equity side of things. When you're scalp trading equities and you're at a prop trading firm, right? I want to show you guys my, let's see, what do we have here? Here we go. Okay, this is my P&L, so to speak, from the last couple of years, and this is from the prop firm. All right, so this is every month documented since I started. At the proprietary trading firm back in February 2007, and as you can see,
you left the prop firm in like what, 09?
09, like early 09. I left the prop firm early 09. I started this spreadsheet a little bit later. I had been trading a little bit longer before this, but this is it. I mean, you see me here trading a piddly amount of shares, a couple thousand shares, and look at this, me making and losing $20. Usually it's just losing $20, $30, right? And this is every day. Like, this is my P&L every single day.
Right.
And fast forward to the point where I became profitable.
Right.
And had months like this where I was making, let's say, $60,000 in a month.
Right.
The problem was that I was trading so much. And I was aggressively trading every single day, making hundreds of trades every single day, opening myself up to a lot more mistakes simply because, purely looking at the numbers here, the more trades you make, the more mistakes you're going to make anyway. And it was really just a grind every single day. And you can see me trading a lot more shares than when I started. You'd have an average volume when I started of 2,000 shares. Now I'm trading 200,000 shares, or 300,000 shares. And you look at the commissions down here. This is gross what I made, right? $75,000. This is what I took home.
Right. They just, it's 50%. Right there.
It's a lot. It's a lot. So when you look at it from a commission standpoint, and you're sitting here trading, eventually, and God forbid you have a down month. God forbid you have a month where, let's say, your gross is down $20,000, and effectively your gross becomes down, your net becomes down $30,000. Because you got to pay X, Y, and Z. It's so much commissions. And I'm like, you know what? In order for this to really make an impact, on my life, and to really get me in a position where I don't have to do this all the time,
right?
Then I really got to come up with something. Because keep in mind, Charlie, it's not like I was making $50,000 a month here. It's not like that was happening. I would have a $50,000 month, but then I would get smoked and be down, you know, a couple grand here, 5 grand here, 10 grand. So it wasn't like I was making money every
Right.
single month. You know, when it was juicy, I was able to make money. But when things were slow, this money wasn't coming in like that.
Right.
So I needed something. I needed something, and I knew it. I knew it in the back of my head. I'm like, what? I got to do something here. I got to do something. And so eventually, you know, the options came about, and then I started messing around with options. And truth be told here, you know, the easiest way to put this is that to get the exposure that you want to have in a particular stock, you can do it much easier on the options.
Right.
So if I wanted, let's say, 10,000 shares of, let's say, a price line, or let's say any stock that costs $1,000, you know, and I wanted 10,000 shares, we're talking about $10 million, money that I don't have. I don't have, and there's no way my firm would have given me that leverage. There's no way they would have.
Right.
But I can get 10,000 share exposure in the options market,
Right.
and I can make the same money in the options market, provided I take that risk. And I was ready to take that risk with the cash that I had because, you know, I had the information. I could understand how equities moved. So it was just a natural, it was like, okay, this is where we need to go. And that was
Right.
it. That was
Right.
it. It was literally a click. And I was like, that's it. I'm done with this prop trading stuff. I'm leaving. I'm wrapping this all up, and I'm just going to options.
I mean, so one of the things you touched on that is something that it basically underlies everything we teach is that your strategy grew out of your understanding of yourself, right? The more you understood yourself, you said, you know, hey, the more scalped equities, the more trades I was putting on, it's a higher volume of trades, and your strategy is actually that you're not aiming for above 50% winning percentage, right? That's not your style.
No.
You're happy to have a losing, you know, a percentage. As we're just blues now. You're happy to have a you know, win-loss percentage of, you know, 30%, something like that.
Absolutely.
Because your winners way outweigh your losers, right?
Exactly. I didn't need it. And to further this whole discussion on why I went to options and what happened when I did
Right.
was that instead of looking at, by the way, at the proprietary trading firm, like, I was looking at hundreds of stocks, you know?
Right.
So I was looking at this times 100, and my eyes were in so many different places at once. You know, that was also another problem. That was also a way to sort of open up all those mistakes that really started to happen,
Right.
and cause me to, you know, have such a volatile sort of P&L.
Right.
And that's when naturally I went towards just trading one stock. I didn't care what anything was doing. I didn't care what anything was doing. And I just went for one stock only, and I went for it on the options market. And what ended up happening was I worked up to the point where I had my biggest month ever, where I
Right.
literally pulled in 1.6 million for the
Right.
month of, you know, and this was August 2009. So I pulled in 1.6 that month. The month before, I pulled in another 200. The month after that, I pulled in more money, and it was unbelievable. And all I traded this month was Citigroup.
Right.
was one stock.
Right.
One stock, you know?
Right.
Obviously, you know, a couple little feelers here and there, but nothing like, you know, I'm trading 100 different stocks. If you looked at my trade reports at the proprietary trading firm, you'd see 50 different stocks every day.
Right. Right.
Every day, and your mind is being pulled in so many different directions. When I've been able to really pull down that money is when I've been focusing, obviously, in the option space and on one stock and one stock only.
Right. And that's something that came as a result of, that's not a one-size-fits-all thing. You know, that's something that came as a result of your understanding the instruments that were in front of you, understanding the markets, understanding the strategies you can use them, and then understanding yourself and sort of syncing all of that up together, right?
Right.
Um,
Exactly.
So, I mean, let's talk about, so you were a good equities trader, then you went and you started trading options, right?
Right.
The skill sets that translated from equities to options, right? I mean, one of the advantages of you trading the way you do is that you're able to carry a lot of your equities, the skill sets that help you be a good equities trader over into your options trading, right?
Yes.
Talk a little bit about, I mean, because essentially you were, you know, now you do more complex stuff, you'll do writing strategies and whatnot, but essentially in the beginning, you were basically going along only.
Pure long only options and
Right.
pure directional, just like I would on any equity. That's what I was doing.
Right.
And the way it sort of translated for me, and actually that's why it was so simple. Like, it really wasn't trading anything new. It really wasn't changing my strategy at all. I mean,
Right.
where I came from was an equities tape reading background. I
Right.
kept that, and the only thing that I changed was I'm going to use this vehicle instead of the equity to actually make money here. And just to give you guys a quick and dirty example here, um, so if we're taking a look at, let's say a stock like Priceline, you see a big move on Priceline from whatever it is, $1,200 here to 1250, a 25 point, 30 point move. Instead of playing the equity here, I would just try to time these things correctly and hop into an option, and literally hop into an option. So this option would be an example of something that I would play, and you see the giant range on this thing from $2 to $12. So I would easily, I shouldn't say easily, but I would basically just take my tape reading skills and use this as a vehicle to make money versus the actual equity, simply because if, let's say, I wanted 100 contracts in this, that's exposure to 10,000 shares of the stock, and there's no way that I had the money to buy 10,000 shares of Priceline.
Right.
I just didn't have that. And these are the names that are really going to give me that range to make some serious money on. You're looking at this option go from $2 to $10, or $2 to 12 by the end of the day. That's an unbelievable money making opportunity. And yes, you can pull that money out in the equity, but do you have the leverage? Do you have the account size? And let's face it, nobody has that account size unless they're filthy stinking rich, or they're institutional traders already, or they're trading at a bank, with unlimited capital.
Right. And what a lot of guys who are, professional options traders or more traditional options traders, if we walked, we know tons of guys like this. When we go to Chicago,
Yeah.
we talk to these guys, and a lot of these guys, they use pricing models that are a lot more complex, right? You
Right.
are doing, there's this quote, I can't remember, I think it's actually Albert Einstein that's talking about like the progression of genius, right? It's like things get more and more complicated, and then you get to this point where it's like simple, right?
Yep.
Like the hardest thing to do in any craft, in any for writers especially, this is very famous, like to write a simple sentence and to communicate something, very difficult to do.
Yes.
So
yes.
that's part of why I kind of get so jacked up talking about your the formula you have. Is it's pretty, on a relative basis, it's pretty simple, right? I mean,
Yes.
and that's one of the reasons you've been able to translate it, I think, to people who who are taking the class. Is like we're not teaching you complex math right here, guys. Like, there's only a couple factors that are really going to determine this.
Right.
And it sounds like you
Right.
you were able to derive a lot of that from your
Right.
experience in the equities, right?
Yeah, I mean, to sum that up pretty quickly, like, guys, I never read anything about options. I didn't even know what an option was until the flux capacitor told me that I could make more money, in the option space than I would in the equities. And I never studied options. I never read a book on options. I never read anything about Greeks or anything. Any of that stuff. So I literally created a system to look at options, to price options myself, to understand options, just through common sense and just through the equity tape. That's literally how I built.
And you continually refined that, right? As time
Exactly.
went on, it wasn't like you just had this epiphany moment. You're like, this is
Right.
how it will work, okay, and then it spit it out.
Right.
I mean, it was every day going in, testing it, tweaking it, going back, testing, tweaking, right? I mean,
Right.
that's how you build a
Right.
good process.
So now, at the point I am now, immediately I'll be able to look at an option chain, look at the prices of these options chains, understand which one to go for, which one is too far out of the money, and all that kind of stuff. And again, back to Charlie's point, like all the traders that we meet, like we meet a lot of options traders out in Chi-Town. We meet a ton of option traders, obviously, on Twitter, retail guys, but not only the retail guys, institutional guys, traders at large proprietary trading firms that are that manage large books. And every single one of them, when they hear me speak about options or when they hear my strategy, they're all like, "Oh my God! So you're a cowboy. You're a cowboy." Everybody will just throw that out on the table. They're like, "Wow! So you go for serious alpha, and you're balls to the walls." And to me, I look at it and I just say, you know what? It's easy to label somebody like that when you're rooted in a systematic approach to understanding options, and you've been taught options. Most people have been taught how to trade options from either banks or wherever it might be, so you've been taught Greeks, you've been taught deltas, you've been taught gammas, vegas, and all that kind of stuff, and how it contributes to your options price. Me,
Right.
I literally just looked at it and said, okay, and looked at it from a common sense approach and said, all right, if everybody's willing to pay for X, Y, and Z, for X, Y, and Z for this particular option, what's going to make them pay more for it? And understanding that simple concept of understanding what's going to make the crowd pay more for an option because of what my underlying is going to do,
Right.
that's all I needed to know.
Well, and sometimes, and I've been present for a lot of these conversations, right? And sometimes when they're calling you a cowboy, sometimes they're like, "Wow, you put X amount of your account at risk," like, damn,
Right.
and
Right.
and Lucci, you do that. You do sometimes just go balls to the wall, and that's one of the reasons you're here, because that works for you. It has worked for you. Up obviously every single day is up until the day you're trading that day, right?
Right.
And one of the things that is, I think, kind of lost sometimes is I will never forget Chaim coming in. And for those of you guys who don't know, Google Chaim Bodek.
Yeah.
He is a guy who is a partner with us, one of the smartest people I've ever met, probably too smart for his own good. We were in the documentary The Wall Street Code with him. He's featured in Dark Pools, great book by Scott Patterson, The Wall Street Journal. He came in, and he comes from the opposite side of the spectrum, right? I mean,
Right.
Goldman Sachs, UBS,
Right.
trading.
He
And
comes from the market maker side. He comes from the side that's selling those options to me. That's where
Right.
he comes. That's where he comes from.
Right, and we're that side, and we're gonna have Brian come in. Brian was Chaim's head trader at their hedge fund, and Brian is now risk manager alongside Lucci, and is the head trader for another fund that we have. And we're gonna have Brian come in and explain sort of the alternative perspective to what Lucci does, in a future webinar, because there's merit to each approach. But what Chaim did is he came in and he analyzed how Lucci was trading, and he was like, this is crazy. He was like, this is so crazy, because the way he and I talked about it at one point is you're basically speaking like you were being a contrarian by doing something, by coming up with your own pricing model in a way.
Right.
And so that meant that you were acting on different pieces, different stimuli, different pieces of information, which meant market makers and whatnot, they couldn't really understand in certain ways, and a lot of times, your behavior. They couldn't anticipate it. They couldn't game you nearly as well, because they didn't understand the motive. They couldn't fully grasp what you were doing. You had created your own system. And so in a market that often rewards you being contrarian, if you're going with the pack, you're screwed. The edge is already already gone.
Right.
So if you want to separate yourself from the pack, there's risk outside of the pack, of course. But
Yes.
you got to do something different, and that is a byproduct of what you've done. And I've had talks with Chaim and Peter and those guys who are more quant, backgrounds, and they're they're like the stuff, the math that Lucci has did in his head that he's not even aware of, in order to come up with this stuff is insane, right? Because it works, but he's factoring in variables and whatnot that, you have it's like you have this computer running in the back of your head that you're not even aware of, and it just spits out like 5. I don't know what's going on.
But that's the thing. It sounds so complex to those who haven't heard it before, or those who or those who come from that side of the industry, who are rooted in the system. And in reality, it's freaking simple. It's simple, and it all comes down to timing and understanding really how the market works from the equity side of things, and then how they work obviously from the option side of things as well.
Right. And guys, we're getting a couple questions here, so and I'm just
Yeah.
gonna. So we are trading, or Lucci's trading primarily weeklies, right? I mean,
Yeah,
he's
I trade primarily weekly. Sometimes I'll hop in something that's another week out or a month out or things like that. But right now, yes, predominantly weeklies.
right, right, right. And guys, yeah, put your questions in there. Ask as much as you want. We're gonna do kind of a wrap up, towards the end and get to a lot of your questions. So, Luch, we promised people that we were going to say, the big lesson that you've learned and that we talked about a lot that separates
Right.
a guy who's only traded equities to the big concept that he has to grasp if he's going to make that transition into options.
Right.
Timing, right? We've talked about this idea. Lay it out for everybody and explain that difference.
Yeah. So, and again, this is something that we're going to allude more to, in the following webinars here. But again, like one of the things about options in particular that you're going to need to start understanding are simple concept like time decay, simple concepts like volatility, meaning how crazy your stock is, and how they factor into the price of your option, right? And there's different ways that you can learn this. You could learn this the traditional way of the gammas, of the deltas, figuring out what delta your option is, and then looking at what the change in your stock price is, and that's how much the change should be in your options and all that kind of stuff. But whatever form or however you decide to learn it, you need to understand how your option moves as a result of the equity price moves. And again, like a lot of people try to shy away. A lot of options traders, they just kind of look at the option, or they look at an option sort of scenario or risk to reward scenario without really taking into account what's going on with the actual stock, what's going on in the actual market. Are we bullish? Are we bearish? There's a lot of environmental factors that they don't really account for,
Right.
and that could end up biting them in the ass, really.
And
that's one of the things I do preach.
Yeah, and one of the things that newer guys come in with that actually is like, it sounds very simple, but it's a concept that can kind of blow people's minds, is like when you buy an option, when you buy a stock, let's start there, that thing will exist forever essentially, unless the world or the U.S. economy implodes, right? It will exist forever, or the company goes bankrupt. With an option, it is constructed so that it will not exist after a certain period of time, right? If you're buying a weekly, it's not going to exist within 7 days. A monthly, that long. And so, and as that when you put that element into the instrument, changes everything. It changes everything. And timing is essential. And Lucci, you've talked a lot in the past about you can be right with your call on a market move, on how a stock's going to respond. You can be right, but you can still lose money in an options trade because
absolutely. And actually, let's pose that question to these guys. I mean, how many of you guys have bought an option and you were completely right on the direction, but you still lost money? And every right, all you 90 people or 100 people in here, you know exactly what I'm talking about, right? And it's this key concept. It's why does this happen, number one? And obviously you can come up with the reasons after, but you need to be able to anticipate this. And your ability to anticipate, your understanding of timing, that's what's going to make you different. That's what's going to make you pull out money from these options. That's also what's going to allow you to say no to trades, which is something that chances are all 100 of you here, if you did a little bit more of, it would reflect greatly on your bottom line, and that goes back to the timing of the situation. And again, there's so many different ways to teach that. People teach it through the implied volatility. People teach it through the time decay aspects, whatever it is. And again, the way that I go about it is just understanding how these concepts affect your options price, and therefore being able to anticipate and make a better decision on if you want to be involved or if you want to just let it go.
Right. And, one of the things that, we've been talking about kind of consistently is like, there's two sort of variables that have gone into the way you trade now, right? Lucci was like understanding how the markets work, how options work, understanding these sort of facts almost, this factual information, even though the markets are sort of constantly evolving. But understanding that, and then it's like your personality, right? When you put those two things together, that is out came your, what you do, right? And
Absolutely.
Friday, guys, we're bringing on a guy named Nate, who is one of Lucci's original students, actually. Very, very intelligent guy, very good options trader. He's full-time, full-time trader, self-employed, has a bee farm down in North Carolina as a hobby. I mean, he's an awesome guy. And Lucci and Nate are a perfect example of how you can have sort of the same base of knowledge, right? Which, Lucci taught Nate essentially everything he knows, but then have such a different outcome in terms of how you apply that, right?
Oh, yeah.
Nate's personality is very, very conservative, much more restrained. He approaches things differently. He's applied what Lucci taught him in a different way. And I think that the discussion between you guys, Lucci, between you and Nate, is going to be really good for people to.
Yeah. I'm honestly looking forward to it as well. I mean, am I going to be interviewing him, or are you going to be interviewing him?
No, what? I don't know.
Yeah.
I might have to make a game time decision on that.
Yeah. So Nate, guys, again, I mean, and by the way, I mean, this is how I've always taught, options in general, or how I've just taught in general. I don't want to be the guy that pushes X, Y, and Z strategy or pushes X, Y, and Z sort of agenda. I would rather give you the information and then tell you, like, listen, you need to use it how it best suits your personality, and that's one of the biggest things that we focus on at St. Lucci. Now, Nate was one of my original students where I used to do one-on-one Skype sessions with. Like, I didn't have all these bells and whistles and everything. It was just a Skype call, and I'd sit there with him for an hour. I'd teach him generally the same stuff that I do now. And he took that information. He spent time with it. He took his he took a lot of beating, in the market. He had some winners. He had some losers. And then finally, he was just, there's a point at which everybody hits, provided they stick around long enough. There's a point at which everybody hits and says to themselves, you know what? I know how I'm going to go about this game now. And they hit that point. Why? Because they realize how they react to stock prices. They realize how they react to when they take a loss on an option or when they take a winner. And that's when the true strategy comes out. That's when the big picture comes out. And you all want to reach this level, that aha moment where you're like, all right, you know what? Now I know how I'm going to go about this. And that's all you're going to do. That's literally all you're going to do for the next 5 years.